Hello everyone, Professor Franz here, and today we're going to talk about monetary policy. We will start a discussion by talking about interest rate and investment. Remember that the interest rate is the opportunity cost of borrowing money. As the owner of the firm, you will borrow money to invest if the expected rate of return is higher than the real interest rate. And therefore, the Fed can soothe business cycles by raising or lowering interest rate. If there is a recession, then the Fed can lower interest rate to encourage investment. If there is expansion, we have a problem with inflation, then the Fed can raise interest rate to lower inflation by curbing investment and consumption. During a recession, the Federal Reserves can exercise an expansionary monetary policy to help with our economy. So the Federal Reserves can increase the money supply, which will lower our interest rate. As a result, firms will increase their quantity of investment. So the investment goes up, that will shift our aggregate demand curve from 81 to 82, and that will restore our economy back to its pre-recession level. If there is a demand pull inflation, the Federal Reserves can conduct a contractionary monetary policy to curb the inflation. So the Federal Reserves can lower money supply, which will increase our interest rate. As a result, firms will reduce their investment, and that will shift our aggregate demand curve from 81 to 82, which will lower the price level and curb the inflation. Recall that Federal Reserve has three tools: open market operations, reserve requirement, and discount rate. If the Federal Reserve would like to conduct an expansionary monetary policy by increasing the money supply, it can either buy government bonds through open market operations, or lower reserve requirements, or lower discount rate. If the Federal Reserve would like to curb inflation by reducing the money supply, then it can either sell government bonds through open market operations, or raise reserve requirement, or raise discount rate.